Good morning, everyone. So another year has come and gone, and a much better year than what we had seen in the last couple of years, I would say. And another edition bites the dust, and we are back. I welcome you back to the 7th edition and the final edition of Fast Food and Cafe Convention. Now, I don't think anybody heard that. We are definitely not the final. We are not going anywhere. There's nowhere else to go but higher and better, right? And thank you for all being there, for being part of our growth story. And that is something that I truly appreciate to each one of you. There are a lot of faces here who've been coming back. And thank you to all of you, and a lot of you who are new to this event. So we look forward to welcome you to many more such editions. We are also thrilled to let you know, like I think I mentioned already last year, that we have launched the event in Dubai, and we've done 2 editions in Dubai. And we are looking at, of course, many more there. But we're also thrilled to announce that we are launching the event in the Kingdom of Saudi Arabia. So thank you for that. And on behalf of George Mohan, who's busy taking a video there, I think, on behalf of him and me, and the entire FFCC team, we welcome you all. Having said that, we have a very good conference agenda and stalwarts from the industry who I'm sure are going to impart their knowledge and share their insights on things which would be valuable to everyone. And you are also open, everyone is open to share thoughts and insights, right? I know we've mentioned it a million times on social media, but yes, we are into the 7th edition now, and we are very happy to be launching the F&B Virtuoso Awards this time, because we feel that we want to do a genuine set of awards and celebrate you all who are working so hard and keeping our tummies filled. So that will be later on tonight. And of course, our team is there outside to help in case you need anything. And I must take this opportunity to thank our sponsors, our platinum sponsors, Food Service India, our award sponsor, Coca-Cola, our gold partners, and all our exhibitors, without whom this event would not be what it is today. But most importantly, each one of you who's here, taken the time out to join us. So thank you once again. And now we have here with us a very special guest, all the way from Dubai, Tapan Vaidya, who is the CEO of PJP Investments, and he's the person responsible for bringing Papa John's to India soon, shortly. So we're waiting for that. And he's also an advisor to our event in Dubai. So I would like to invite him to say a few words. Please.
Thank you, Minnie. Good morning. I am honored, humbled, and thrilled to be addressing you all this morning. Back in Dubai, my karma bhumi, I end up speaking at events a couple of times a month. We just do too many events in Dubai. And therefore, addressing you in my Matrubhumi is very special. And to see this hall full of people is such a refreshing change after the pandemic. Of course, this is the 2nd edition after the pandemic, but it's lovely to see you all. What I normally look forward to at such events is to keep my ears open, pick up all the pearls of wisdom that come from all my contacts. I expect to do exactly the same as we embark on our India journey next year. I hope to understand everything that I can from all of you. So please feel free to reach out and give me all the advices you can give. But equally, I hope that you also will enjoy this event and pick up as much as you can and go home richer at the end of this evening. Thank you, Minnie, thank you, George, for putting this up, and I wish you all the best. Thank you.
Now I would like to introduce you to the convener of the event, Kapil Malhotra, founder and MD of Total Solutions Group, who will be with us through the day. Over to you, Kapil.
A very good morning, everyone. Good morning. So first of all, it's a true pleasure and an honor to be the convener at the 7th edition. I remember a few years ago jogging my memory where George and Minnie took me out. It wasn't a meal, but it was a beer. And that is when they were putting their ideas together of starting with the first FFCC convention many years ago. It's so pleasing to see that we're in the 7th edition, which has not only been in Bangalore, but so have these editions moved globally. I think a clap to Minnie and George for doing a fantastic job. And all the stalwarts out here is a testament of how we have enjoyed the FFCC sessions. Thanks, Tapan, for coming in from Dubai all the way. Biju, you've been a great support. Everyone else, thank you so much. As the convener, I declare the FFCC open today. Let's have a phenomenal, fantastic time. Keep your questions open at the end of the session, wherever we'll have time to pull you in. I'm going to start with the first panel straight away. So we're going to start with a panel discussion that is known as the investment conundrum. I, being a chartered accountant, having invested in close to 100-odd startups today, few of them being in the F&B space, it's been a very interesting journey. Few of them have been on Shark Tank, the other ones have raised significant capital. It's going to be very interesting to see how we take things ahead. Can I invite the first panel, the people on the first panel? Minnie, I can't see the names very clearly, but I can make out by the faces. I think, Biju, you're going to be on as the moderator. So let me welcome Biju Kurian as the moderator for the investment conundrum, the what, how, and when. I think the rest of you know who's going to be in the panel, so please join in. I can't see the names very clearly, or am I losing eyesight? Vishal, right? Vishal Pereira, please join in. Okay, great.
Please sit. So thank you, Kapil, for getting all of us onto stage. Very good morning to all you ladies and gentlemen. I know it's a tough morning. We've got rains overnight. We've got traffic all over the place. Those who live in Bangalore know how difficult it is to be able to get to a place on time in the morning. But nevertheless, we are ready to start. The session that we have today, the panel discussion, is the investment conundrum, the what, how, and where. And when we think of this from the food services industry, think of it from a food services startup, it's often a challenge to figure out, how do you get yourself off the ground? How do you actually begin walking? How do you begin to run? And then finally, at the end of the day, do you call it the end of the race or not? We have with us a group of people on the stage. These are people who've invested in various food service startups and other businesses too. So investors as a category, there are operators as a category, and there are those who are a combination of investors and operators. So you have those who've invested money in actually a food service business and are building it out to scale and building it out for valuation. So when you think about it, think about what form of investment you really want to get. So the whole way we want to keep this entire panel discussion is I'll take about 5 minutes to kind of just highlight a few points. The second part of it is we'll throw open the discussion to the panelists on stage with a series of questions. And if time permits, because I know our panel discussion duration has been shortened to 50 minutes, and if time permits, we will actually accommodate a couple of questions from the audience. When you think of a food service business, you have to think of a business which is extremely difficult. And why I say extremely difficult is unlike, say, for example, a technology business where your investments are at the beginning, and then you're beginning to see returns on that investment as you go along, and your scale benefits start kicking in. In the case of the food services business, your investment starts sometimes maybe a couple of years even before you begin to see the first rupee of revenue. So there is a requirement to be able to figure out how do you want to fund your dreams, how do you want to build this business out, and how do you convince yourself that this is something that makes sense and it is investment worthy. So that's the first challenge that many food service startups have. The second is that when you've figured out that it makes sense and you want to scale it up, then you go out to be able to raise funds from others. When you're going out to raise funds from others, in the beginning you only had to convince yourself and get that conviction that what you're embarking on is a great business. Now you got to actually go and convince others too that what you've embarked on is a great business. And classically, the ones who always lend a ear to you for these kind of things are what you call as friends and family. So you go to friends and family and you say that I've started this, it's good, why don't you come over, taste, put some money into the business, and then you kind of build out a friends and family round. And once you've done that and you've then probably taken it from 1 to maybe 2 or 3 locations, you then begin to feel that, that this is an idea which has actually got legs to stand on. And when you think about it as that kind of an idea, you then want to scale it up. And when you think about the food services business, there are several places you can get beyond friends and family. Some people think, why don't I go to a bank and get a loan? Some people say, why don't I go to a VC and get them to invest in the equity of this company? Some people say that, I don't really need long-term investment in the form of equity. Can I get short-term debt? So somebody looks for some form of structured finance. So there are several ways that they really go out to be able to seek the kind of money that they think is required for their business. Then there is another stage, which is that when you actually have to go out to an institution, how do you choose which institution is right for you? And I can tell you that this is as strong as a marriage. You've got to take time to figure out who is the right partner for you. And in spending the time to decide on who's the right partner, there are several things that you've got to figure out. What are my long-term aspirations? What is my partner's long-term aspirations? How are they looking at it from investment in my business? Are they thinking of running my business? Are they going to be letting me run my business? Will they make me run at a pace faster than what I'm comfortable with? So there are several such thoughts that need to be evaluated before you decide who your long-term partner is. And then finally, at the end of it, a partner who comes in as a financial partner is looking to be able to flip that investment. Will I flip it through an IPO to the public? Will I flip it to another in a secondary sale? So these are questions that the partner has to think about. You've got to be as concerned, because if you're a public company in the food service business, obviously there are obligations on you as a promoter in terms of reporting, in terms of answering the street, in terms of making sure that there's consistency in terms of performance. So there are several such challenges. So what we have here are a group of people who can possibly throw some light on some of these queries, questions that a lot of us have. So let me first start with Nitin Motwani, who is actually the Chief Business Officer for Culinary Brands. And Nitin has been, in the, he's both a chartered accountant on the one side, and I heard Kapil mention that he's also a chartered accountant, so maybe there is something about chartered accountancy and food services. He's a chartered accountant, came in from the accounting side through some of the big four consulting companies, and now is running a food service business, which is both an investor and an operator, and the most popular brand they have is Subway. So Nitin, when you want to look at it, when you think of the food service business, and when you think of investing in it, it's a tough business to invest in. We know all the challenges, and Diksha sitting next to you will echo a lot of those challenges. What are some of the factors that you take into considerations when you evaluate making an investment in a food service business?
Thank you, Biju. Great to be moderated by you, who is the stalwart in this industry, and glad to be part of this esteemed panel. Some more bit about culinary brands I would like to share. So, as you know, Subway is world's largest QSR. Culinary brands also houses one of the top 10 coffee maker, that is Lavazza. I've been in food and beverage services industry on both the sides for over 15 years, and therefore have been fortunate to look into P&Ls of most of the formats. Being a chartered accountant, that's the easy one for us to look into how the financial performance looks like. But coming out of that, I think the most important aspect of any business one is looking to invest is will it be able to achieve the scale? And for any business to achieve the scale, I think the most important aspect is the brand relevance. To build the brand relevance, one has to have product market fitment. And specifically, if I talk about QSR, this business works based on how much average daily sales per store is doing. And average daily sales is made up of average price per check and average daily transactions. Number of average daily transactions will end up making a unit economic model. And if that suffices the need of certain trade area, then you kind of keep multiplying. And that's how Subway today in India is over 750 restaurants. So I would call it as brand relevance, which is most important thing to increase in order to have repetitive customer, increasing customer base, eventually leading to scale with the right unit economic model. Because unless you are profitable and unless you are able to throw right payback and IRR, it is very difficult to sustain such investment, taking it from value creation to eventually exit. So that's what it has been my experience.
Thanks, Nitin. And Diksha, following on the same lines, you've been, Diksha is a co-founder of Samosa Party. And as you all know, samosas are, an integral part of Indian cuisine. And she's taken a simple samosa and she hasn't complicated life. She's actually kept it simple. But the simplicity of the offering is what has actually helped her to be able to scale across 3 cities now, or 4 cities? 4 cities at this point of time. And of course, very, very successful. Diksha, you've actually, been part of the hospitality industry, working with several companies, and then you embarked on your own journey of Samosa Party. One of the things that you've done is you've actually first identified a concept that you wanted to pursue. Secondly, you've then built out that concept and you've grown it as an operator, because you understand clearly that when you want to scale that concept, it requires a certain unit economics, it requires a certain amount of funding, etc. You've also raised funding over a period of time, and I think, 2 or 3 rounds of funding at this stage, which is what you've raised. You've had the opportunity to be able to raise different kinds of funding. You could take it as equity, you could take it as debt, you could take it as short term, you could take it as a convertible note, in whichever form that you wanted. What might be useful is for us to understand as to how did you go about this entire journey of actually raising money for your business, and the form in which you raise money. That is, whether equity or debt, whether short-term, long-term, immediate ownership, long-term ownership. How did you actually go about? What are some of the thoughts that went through your mind?
Sure. Thank you, Biju. So glad to be here and representing Samosa Party. So in terms of funding, right, I think fundamentally the one and only thing I believe in is the best way to fund your business is through your customers, right? And if you get that right, then everybody else follows, whether it is debt or equity or VCs or angels, everybody will follow you if they see that, you know, your customers are willing to fund your business, which is by way of sales. So if you're getting those average daily transactions right, you're getting your unit economics right, then there's so many avenues of capital available to you. I think, and during my time in fundraising, we've done 3 rounds so far. We've done some rounds in very distressed times as well, which would be, you know, in the peak of COVID, we raised our first angel round. Then the next round happened in slightly better times and so on. So I think the one and only learning with respect to these has been that, you know, just raise only as much as we required, and that should be fundamentally the goal. Keep the business fundamentals strong, so, you know, each of your units, each of your outlets should be making money on their own, and then you only raise as much capital as is required for your growth, right? And growth could mean growth in terms of revenue footprint, or growth could mean brand building, or sometimes you want to invest ahead of the curve into the back end, you want to invest ahead of the curve into the teams and so on. So that is how we've sort of set out our fundraising targets as to how much money do we need to achieve these kind of goals, not raising too much, not diluting too much in terms of the equity, and that really has been the way that we have raised. And this is something that is getting appreciated more and more in today's environment. I think 2 years ago when we were raising, there was more noise around, you know, raise more, ask for a higher valuation and so on and so forth. But I think that time is gone now. And today what we see is a lot of rationalization. We see sensible conversations around, you know, what kind of money are you raising and where does that get you to? And goals are not just about top lines anymore. I think goals are about strong fundamentals of the business, strong unit economics, and the ability to scale and give the right kind of exit.
Sure. Thanks, Diksha. Thank you. And Hari, the next question is to you. You've got an investment on your right side, and you probably have a potential investment on your left side. So you're in the middle of 2 investees that you could actually, or 2 investments that that one you made and one you could potentially make. You're an engineer turned investor, okay? And you're part of what we call as the angel network community. And really speaking, for food service startups, they all look forward to angels. And as I mentioned in the beginning, invariably the investment curve for a food service startup is very different from, say, a consumer tech startup or a tech startup by itself. So obviously it requires a very different approach to investing, a different mindset that you have to have when you actually invest in food service startups. So when you really think about a food service startup, and as part of your angel investing, you made several investments, what is the kind of framework that you bring to understanding, evaluating, and deciding whether you want to, you know, invest in this food service startup or not?
Good morning, everybody, and thank you, Biju, for asking this question. First of all, I am an outsider to this industry. I don't understand anything about food. But over a period of time, you know, having worked with founders, now I'm going deeper into the food industry, and I can tell you the food services industry in India is the most vibrant and has got tremendous potential for growth. In fact, I'm very bullish in this sector. Just today, I sent a post in LinkedIn. There are 50,000 outlets in the US of the top 3 QSRs. For example, Subway, McDonald's, and Starbucks. In India, all the 25, 30 brands put together, we don't even have 10,000 outlets. And our population is 5 times that of US. So I think the food service market in India, we're just scratching the surface. There's tremendous opportunity, primarily now with technology and with the highway paved by both Swiggy and Zomato. I can see a tremendous opportunity for any food business. So what do I look for? You know, typically look for the founders to have enthusiasm and to understand that the market is humongous. And they should have the guts to go and sort of build a 10,000 store type of a business. It is going to take time. I have seen companies like Wow Momo. When I first gave the term sheet to Wow Momo, they were at a valuation of 6 crores. Today, they are almost 3,000 crores. The same thing I've seen with Bauxite. The first round, they were valued at 2.25 crores. Today, their valuation is close to 2,500 crores. I've seen this in the last 7 years. So I can see many, many such companies, which will have this type of a multiple as I go forward. Any investor in the food sector business really needs to have patience because it's not a short-term game. So you have to look at a 7 to 10-year type of a window in terms of investment. And 100x is absolutely possible if you work with good founders and good brands. For example, Samosa Party, we are all very confident that it will reach 1,000 crores of turnover. Because look at the Indian market. Indian market, probably we spend close to, maybe 5 crores samosas a day all over the country. 6 crores, yeah, 6 crores, that's the number. On an average price of 10 rupees, it's a 60 crore market daily. So, it's a humongous market growing, and with technology coming in, I don't see any reason why somebody cannot produce at least 5 lakh samosas a day and sell it across the country. So it's quite possible. So it's a very small product. So if you take the same thing with other products, if you take some of the South Indian brands, we have not created a McDonald's or a KFC with many of our Indian products, right? So samosa is probably one which can actually go across the globe, served warm and other things. So like that, there are a tremendous amount of Indian food which can all go global and can actually challenge the big brands like McDonald's and KFC. And today technology is there. For example, we have talked about EV, artificial intelligence, plant-based meats for the last 25 years. Only today they have come to a reality. So I do see a situation where it is a reality today for some Indian food and Indian food brands to actually go global and probably have 10 to 20,000 retail outlets across the globe. But this is going to happen in the next 15 years. So I think entrepreneurs are very important. So if they have the vision, the money is there, the market is there, all you need to do is, leverage that and build a good model which can scale across the globe. So tremendous opportunities for the Indian food sector. I would say it is today much better than the IT sector, IT services sector. So in the next 10 years, we are going to see magic from many, many entrepreneurs who are all going to be billionaires. Many food entrepreneurs who started from scratch are going to be billionaires in the next 10 years. That's my prediction.
Thank you. And many investors in the food service business will also be billionaires, to just add to what Hari said. Abhijit, let me pose this question to you. One of the challenges that you see in the food service business is, when you start one concept, you believe in that concept, okay? When you believe in that concept, you kind of play it out, you scale it up, you tweak it, you make sure that you get it right. Till you get it right, you can pursue it. Now you need to scale. And when you want to scale, then you actually look outside for funding. You have come from a background where your family runs several businesses, and because of which you've been able to fund your own startups. One of the biggest challenge entrepreneurs face is that when they have to go out, they have to convince somebody else about their story. They have to be able to convince somebody else about their aspirations, and they have to make sure that it all translates into a sensible business plan for somebody else to actually invest. You don't have any of those challenges in the case of Pizza Bakery, and which has also led you to open up another one, which is called Paris Panini. So when you think about having built a business from scratch, completely bootstrapped, as opposed to going out for investments, what are some of the thoughts that have been in your mind? Why did you want to not seek outside investment? How long do you think you can actually pursue this journey without outside investment? Are there ways of being able to get outsiders to invest in your business without actually parting with ownership? Are there ways to be able to scale this business without getting an outsider to interfere in the way you actually run your business? So what are some of your thoughts on that?
So good morning, everyone. Really nice to be here. Like Hari was saying, he's an outsider into the food business, but learning more about investments. It's the exact opposite for me, where I'm learning a lot more about the investor space because they just keep approaching. And so the conversations have to be had and the learnings have to be learned. So thanks, Biju, for this question. So firstly, small correction, my family just runs one business. So it's a very obsolete travel agency. The pandemic all but killed it. But I was managing that business for the first 5-6 years of my career, and then through the accruals of that business is how my brother and I started the pizza bakery, and eventually Paris Panini. So our main reason for starting the business was very much the average entrepreneur's reasons: to make money, to feed the family, hopefully have something that is sustainable and way more profitable than running a travel agency in the 21st century. So it wasn't a case of family signing a large check or anything. There was no such thing of that sort. One thing we realized very quickly was that in the food space, there were two kinds of entrepreneurs. One was the entrepreneur who hadn't figured out his model, and because of that, he just needed to sustain. In order to sustain, he had to raise money, because the first maybe 2-3 iterations of his product or whatever he's trying out, they haven't worked. He spent 9 to 12 months. He's running out of his initial capital. He's burning through everything. So he approaches angels, or he approaches friends and family, whoever will give him, that'll give him money so he doesn't have to go back to his day job or doesn't have to go back to his family business or whatever it is. That's one entrepreneur. The second entrepreneur is someone who has kind of figured out a model, but wants to raise for beefing up that model and wants to play the valuation game for various reasons. This whole media hype, I'm sorry to say, but it's so enamoring. Like, I'd be lying if I were to sit here and say that it hasn't tempted me, right? It's amazing, raise 3 million at a $30 million valuation, raise 3 million at a 10 million, and you get press, and then you get people talking about you and all of that. So that's a very attractive reason, but if you do that too early in the bootstrapped entrepreneur's life cycle, then what you can do with your company in terms of flexibility, has far diminished. Because now the investors put money and you have a responsibility to scale and give him returns, because he needs to sell it to the next guy. And this is where our thought was, if we figure out a model that is funded by customers, as you were saying, we'd be able to think about the business the right way. We'd be able to raise capital through our customers and grow through our capital. You were talking about a company being worth $1 billion easily or $2 billion easily. In the next 5-6 years, there'll be billionaires in this industry. So you can imagine if you build a 1,000 crore company and you actually owned like 100% of it. Like, why not? Like, people think to build a 1,000 crore company, you have to dilute 95% of your equity and hold 5%. Right? It's not necessary. If you hit, and we've been fortunate enough, it's hard, it's extremely hard. But if you hit a runway wherein you're breaking even on every new project in 6 months, 8 months, some of our projects have broken even, I'm not bragging here, but this is possible. Like, I'm sure there's a lot of entrepreneurs in the early stage sitting there, so I was sitting there once too. So if you're breaking even on every project, every outlet in 4 months, 3 months, 5 months, 6 months, 8 months, why raise external capital? You can just borrow, you can raise debt if you really need like the runway, right? Maybe you won't, maybe it'll take you 10 years to do something through accruals rather than doing it in 3 years through external capital, but in 10 years you'll own 100% of it. Or maybe you won't have to raise like 8 rounds, maybe you'll only have to raise 2 rounds, right? So that's how I would think about this whole investment landscape very broadly. Raise money only if you really need to. Like Samosa Party was saying, the pandemic was a tough point for a lot of entrepreneurs. You have to raise to sustain. So at that point, you can't sit on your high horse saying, I want to own 100%, and you have nothing though. You don't own 100% of nothing. So at that point, maybe you'll need to dilute. So raise strategically, raise to sustain, raise responsibly, as you were saying. But do not raise for press, do not raise for hype, do not raise thinking that that's going to get you somewhere, because finally what's going to get you somewhere is customers coming through the door and paying you constantly, paying you for your product, building a sustainable product. And in the food space, and I'm speaking about the productized food space. In my case, it's pizza and panini. If you figure out your product right, people will buy from you for the next 10, 15 years. We've run this company for 5 years. I can confidently sit here and say for the next 10 years, people are still going to be eating our stuffed garlic bread classic with sun-dried tomatoes. You don't have to over-innovate. You don't have to do all sorts of tech stuff. Like you can just open more and more slowly. So that's my view on this whole thing.
Thank you. You know, it's, I think, very well articulated. Just the simple principles. You know, what Abhijit mentioned. Make sure that at a transaction level, you make money. Important. If you look at many e-com players today, that's a challenge. Make sure that at a unit level, you make money. Make sure that you generate enough money, which means he talked about payback. How do you make sure that the payback of that unit is as short as possible? Make sure that you generate enough cash from your existing operations to fund your future growth. And at the end of the day, you can actually get to 1,000 crores as he defined without actually seeking 1 rupee from anybody outside. Abhishek, a question to you. I think the important thing here, when you see all of them, is the fact that several one of them, when they reach 1,000 crores, when they reach 2,000 crores, will all seek to go public. Okay? And I'm not saying this without qualification. There are several large companies which have decided not to go public just to make sure that they're not answerable to the street. But several will want to go public because that then creates liquidity for their investors or on their cap table. It will create a marketable share for them. And obviously, if you want to then transfer wealth, it's a lot more simpler for a promoter. So when you think of, you know, going public, all companies can't go public. There are several things that they need to do to be able to prepare themselves before they go public. And this is like the bride preparing herself for the wedding ceremony, and I don't want to make it sexist. It's also like the groom preparing for the wedding ceremony. There are a lot of things that they have to do before the big D-Day. What are some of those things that companies need to make sure that they tick off on their checklists to ensure that when they become public, that they're actually public worthy?
Thanks, Viju, for having me here, and it's good to represent ICICI. We've been active in the capital markets, having done a bunch of IPOs and other capital market events for hospitality and the food and food services players. As some of the panelists clearly mentioned, unit economics is one of the most important things, right? Whether you own 100% or you own 5% of your company, if you have the unit economics in place, if you have that brand, if you have the unit economics in place and if you have the brand equity in place, customers will come back to you, which will lead you to generate more internal accruals, which will make you attractive to more institutional or other external investors. Whether you decide to take it or not is a different decision. And this will help you scale. But to achieve a capital market event, to achieve an IPO status, the magic words are 100 crores of EBITDA. You may not have achieved that, but you need to be able to achieve that in the next 1 or 2 years, right? Yes, in the last 2 to 3 years, there have been certain companies with huge amounts of losses and negative EBITDA coming to the market because SEBI has certain options available for companies to come to the public. But then that requires you to convince institutional investors even more that, look, I will get there in the next few years, and this is the valuation where I would like to list at, and if you think that is correct, please invest in my company, right? That is one thing from an investor point of view. But as an entrepreneur, you need to achieve scale. So therefore, to achieve that 100 crores of EBITDA, if you need 1,000 crores, 2,000 crores, 500 crores, whatever is your top line, you need to achieve that. To achieve that, how many stores do you need to set up? Do you need to be a regional brand? Do you need to be a pan-India brand? You need to have geographies outside India? You need to get there. That's on the market side. Doing an IPO itself as a process, it is very, very challenging for 2 teams especially. One is your finance team and one is your secretarial/legal team. You need to get your house in order. You need to have all your licenses, agreements in place. There will be lawyers who will sit and do a very deep due diligence on your organization. And you don't want to get to the market and have an event where there is a raid or there is a lawsuit against you, which will just dampen your prospects, right? And you don't want your CFOs and your company secretaries to spend 4 a.m.s in office. So if you envision that you're going to reach that scale in the next 2 to 3 years, start now. Start hiring the right people now so that you are ready for that event whenever it happens, right? I always keep telling people that the capital markets is like an everlasting party. It doesn't matter when you come to it, it matters how you come to it, right? And you need to decide as an entrepreneur, as a food service company, when you are ready for it, right? The party is there to accept you, and you need, to an extent, we need to thank some of the peers who have listed, right? Jubilant has given, ever since its IPO, a 25% IRR return. Sensex and Nifty have achieved around 15-16% odd. So there is a 8 to 10% alpha that has been created, right? I think Nitin will want to achieve 25% in the private domain at Subway, right? Now, if Jubilant has already achieved that in the public domain, investors have really seen that there is merit in this industry. And as penetration in India in almost every category is so low, right? And as India keeps growing, there is humongous scope. So I would just advise investors, get your house in order, clean up your cap table if you need to, get as less investors if you want to do pre-IPO rounds, get that extra level of funding, get few investors on board who are going to back you. There could be events where you may want to list, but market conditions are not conducive. You may want to backtrack on your IPO plans. You need investors to keep backing you on that. You need to have your entire human resources in terms of having a proper CFO, in terms of having a proper company secretary, a legal team, and everybody else well-oiled and having 2 to 3 years of experience at least within the organization to help you out. And yeah, then hope for the great markets to have a great valuation outcome.
Sure. Anything that you need to guard against? So effectively, when I say guard against, what I'm saying is that there have been several cases of companies, paying themselves, promoters paying themselves out quite handsomely before they go public. There have been cases where reserves have been stripped out of the company before the company actually goes public, because you only look at it from a P&L perspective and not from a balance sheet perspective. There have been, cases of window dressing happening before a company goes public. So what are some of the things that you need to guard against when you go public, before you go public?
Well, corporate governance is above board for anything. If you have everything else in place but bad corporate governance, I'm sorry. Even if you are at an angel level, Hari will tell you, sorry, I am not going to invest in you, right? And even whilst Hari will do a lot of...
The trouble is some of those angels turn to be demons before they go public, saying that please give me all this money out, before let the public take less.
That is a very dangerous strategy. I know there are funds which have exit timelines and they need to exit and they need to give their LPs returns. But again, you need to be ready when you are ready, right? You can't have shortcuts. See, the capital markets investors and capital markets don't do as much due diligence as a private equity or a growth style investor will do. They will not appoint a big four and sit for 6 months and get through every nuts and bolt. But this is a liquid market is what you need to understand. If you promise something to a public market investor and don't deliver on that, yes, they will give you a leeway. They will understand there was a COVID situation. They will understand you didn't meet your targets by 10% or maybe 15%. But if you have a 30%, 50% miss on your targets, you are going to lose them forever. And your stock could drop 50%, 60% in a few days. We've seen what happened to a few large companies in January, February of this calendar year itself, right? And your stock could really, really drop. And once you have lost that investor, he's not coming back soon. Then it's an uphill task for you. Therefore, if you even think as an entrepreneur that the fair value of your company is X, it is better to put some money on the table, get your IPO done at X minus 10%, X minus 20%, and then you will see the investors backing you even if you have a miss a few quarters or a year or two in the future, right? Because they are going to back you because they have seen that they are making money on this investment and they are going to be there with you for the long run. And yes, please do not try to make shortcuts. You will get found out someday or the other. So again, no window dressing. If you are, and investors are quick enough. Institutional investors will triangulate. Most of these investors are investors in Jubilant, Westlife, Burger King, Devyani, Sapphire Foods. They know the industry in and out. They know the unit economics. Even they don't do due diligence, they will talk to funds, they will talk to research houses like ourselves, they will talk to other people, they will do expert calls with the industry participants without any of us knowing that they are doing this, right? And they have been tracking these sectors for the last 10, 15, 20 years. They are smart enough. Please don't judge them for fools. Please don't do any things that could hamper you. It's like putting yourself in the dock.
Sure. Thanks, Abhishek. Vishal, first of all, let me thank you for helping prepare some of the questions for the audience out here. Vishal is the one who was my think tank on this in terms of making sure that we got the flow of the questions right. Vishal's the managing director of CreedCap, which is both an investor and an advisor to several companies, not just in the food services space, but also in several other spaces, including technology. So when you think of the food services industry, since that's a forum that we have today, and when you think of their fundraise journey and the opportunities that they have at different stages of that journey to source funds from different sets of people, you know, whether it's, as Hari was mentioning, angels, friends and family, all the way up to private equity, or if you place yourself in the hands of Abhishek, you'll also go up to the public. So how do you think of advising these companies, saying that what is right for which stage of the course?
Yeah, Viju, thank you. Hi, everyone. So look, when I founded this in 2010, I think one of my inspirations to begin this firm was when I saw an article in 2008-9 where it said that Axel invests $5 million in Kati zone, and that was in the front page of the Times of India in, I think, around 2008 to 2009. The whole investment landscape has changed drastically from 2009 to where it is today. Back in the day, one of my first deals, and F&B is very, very sort of close to my heart. So one of the first deals and one of those deals that got us off the ground and into the whole ecosystem was when we did a raise for this brand called Ammi's Biryani. We met Nawaz when he had about 2 or 3 stores, and the only option, and he was not even a private limited company. He was a proprietorship. So the first thing we had to do was change his structure, and he had the sort of intellect to understand why this is good for him. But even at that time, 2010, Nawaz had just 2 options. Either raise equity funding from friends, family, ecosystem, whatever, or he could franchise out his business. Now, when I look at this about 14 years or 13 years later, and some of my portfolio companies, so what I do now is first I invest in F&B companies and then I advise them, because I think just being a transaction advisor at this stage is a very, very thankless job. So you have to put your money in first and then sort of help them grow these businesses. But if I have to compare 2010 all of those instruments that were there for you to raise money, for you to grow your business versus what is there today. I think at least about 6 to 8 new instruments have come out. And I'll also give you some examples, which is why there's an emergence of even the cloud kitchen business, which without capital, you're not able to scale as much as you see, right? So now you see brands that own 8 to 10, now you see platforms that own 8 to 10 brands which are digital first. But these guys also need capital for them to open these stores. So where does that come from? Everybody cannot raise equity. While there's a lot of liquidity in the early stage market, I think only looking at equity as a form of growing your business is absolutely wrong. But I think over the last 4 or 5 years, you have instruments such as asset finance, where platforms like Grip have been able to come, where you're able to list your business there, and you're able to raise money from peers through a structure, and then grow the number of stores, which I think Diksha must have done over a point in time, and I think even Abhijit may have explored that at some point in time. Then you have something called RBF, revenue-based finance, which again was an instrument that was not available for the early stage ecosystem even about 4 or 5 years ago. So when I work with founders, I think one is I think the one thing that I want to sort of check with them early on is that they don't have an identity crisis. And what I mean by that is people read the news quite a bit, and it's very looks very sexy, and that fundraising is a very easy task. But a lot of them do not realize that it's a fiduciary responsibility also. So I think the first check for me is to see whether they know who they really are. What that means is, do they have the right structure in place? Do they have the right number of revenue, what we call as ARR, run rate, for them to be eligible to go out and raise capital? If they're able to raise one round of capital, will they actually be able to give these guys an exit over the next 4 or 5 years? So one size fits all is not the right way to look at it. It's not just about raising equity. I think that's the most sexiest topic that is out there, raising equity from XXX. But there are multiple ways for you to grow. And even within my portfolio company, one of them is a large offline F&B brand. And just by introducing them to these 2 asset classes, which I mentioned, which is asset finance and RBF, they were able to almost triple their stores. They were at 18 stores in March of 22, and as of today, they're at almost 54 or 55 stores, with raising hardly about 3 or 4 crore of capital, and about 20 to 25 crore of asset finance and RBF. So these are models that are out there in the market, which I think has helped this whole F&B or the food service ecosystem to accelerate. And I completely subscribe to what Hari said, that we can have made in India brands go global. I think the next Samosa Party, the next Pizza Bakery, I think Pizza Bakery can also go out to other countries. And I think we have a great ecosystem today, which was not available when I started off.
Thanks, Vishal. We have 6 minutes left in the session, and I promise the audience we've got a full house here. Can we have questions from the audience? At the most, we can take 2 questions, and each one of you all can just state your name, indicate who you want to address the question to, and please keep the question shorter than the answer.
Yeah, hello, good morning. Am I audible?
Sorry, can we get that mic operational, please?
Hello.
Yeah, we can hear you.
Good morning, everybody. This question is posed to Diksha Ma as a woman entrepreneur. And I also, being a woman, if I want to invest or start a business, I would like to know, did you go in for a short term or a long term initially? And what was your investment plan? Did you first foresee your business success and then went in for the long term, or were you prepared for long term? And what was your initial investment?
Madam, you're asking for a whole business plan. Okay? So, Diksha, could you just confine your answer specifically to whether, how did you think about funding your business? Keep it like that.
So we didn't start with the thesis of, building a venture-funded business. In the beginning, even we wanted to keep it bootstrapped. And then we realized that, the idea was scalable. We were getting a lot of customer endorsement. We'd found the product market fit. And I've spent a lot of time in the industry already. I've spent 20 years in food and beverage. So having seen that, this is something that could be scaled, and the only thing that was coming in the way was the time that you would take to scale, right? I could either make it a 20-year project, or I could say that in 5 years I want to get from year to year. And if there is only capital and resourcing which is stopping me from doing that over the next 5 years, then I look at, what's the capital I required, what's the best possible instrument to use over here. And like it's already been pointed out on the panel, again, when we looked at financing, we didn't just look only at equity financing, right? All of these instruments, plus also I would like to add even some long-term loans from banks, right? Long-term term loans also. If you're running a profitable business and if the banks can see that you will be able to return their money, even they have some very good terms to offer today. So of course you never are ready from 0 to 1,000. You never will be. Even on your 900th, you will still think that, will I be able to go the extra 100? But every day and every year as you grow your business, I think your ambition becomes bigger. At the same time, you also become humbler and rooted around, how much can you bite and how much can you actually chew, right? So that's how we went.
Thanks, Diksha. Sorry, we need to get another person to ask a question.
Yep. Hi.
So you could actually meet Diksha separately and ask her the rest of your follow-on questions.
Hi, Jay here. So my question is regarding the expansion and the investment. So we run a cafe. We have 2-3 cafes right now in Bangalore. And my question was particularly when you're looking to expand, there is either a model of infusing your own funds or go through a franchisee model. And in franchisee itself, there are multiple models, like you have franchisee operated model, company operated models. So if anyone from the panel want to take this up and answer that, what are the top 3 metrics which can help us decide which model to opt for while expanding for your business? And secondly, in terms of when you're talking about different ways of raising funds today available, whether it's revenue-based financing or CSOPs program which are there in the market. So yeah, what are the 3 metrics which can help us decide on both of these terms? For expansion, what is the best way? Either we should go for a company-operated models or franchisee-operated models, or open our own stores, which is a very high capital-intensive array. And for investment, which is the best way to go forward when you're at a very initial stage of 2-3 outlets?
See, actually, can you hear me?
Yes,
Yeah.
yes.
See, actually, there is no single answer or simple answer to this. In India, investors typically like the brands to have the total GMV, which means that the brand sales is very important and it should be in their own books. That's a typical mindset of Indian VCs, or I would call it a foreign VCs who are in India. But I think that, the franchising market is a, humongous market in India. For example, just imagine if somebody has to set up 1,000 stores in 2 years and they need to put in 50 lakhs per store. The total amount of money, no investor is going to give you as a single check. And you really require, at a store level, you require entrepreneurs to manage the store, because ultimately it's an experience that you're creating. So as long as you're able to build a brand and you're able to create other entrepreneurs within your brand who are all going to profit because of the food is good, people come back again and again. I think India has got a tremendous potential in the franchisee business, because you don't need investors also. The franchisee can fund all your stores and they are making money out of it. And you can break even in 3 months, 6 months, whatever it is. So I think that is a great model. But only thing is, in India, we still don't trust franchisees. That's one of the biggest problems.
Also the SOPs part and things are not maintained.
Yeah, so in that model, you can have, there are many investors. India has got a lot of people with a lot of money. Now they are putting money into banks or into other instruments, right? So if you find somebody who is able to put in 50 lakhs, you tell him that I'll give you 2 lakhs a month, that's it. So he'll be very happy. You manage the business. So franchisee owned, but company operated or brand operated. That model is excellent for India because there is a lot of cash which is totally lying idle. And people want that money to be put into better use. So anybody who wants to build a 10,000 store business or a 10,000 location business has to look at franchising, because it is not possible for a company to set up the infrastructure to set up 10,000 stores in 3 years. And today we have to be in a hurry. Otherwise we have to do M&A activities, because the market is growing very fast, and unless you reach 10,000 stores in India, you have not arrived. That's the type of speed that I want to see, especially from food entrepreneurs, and that could happen only through franchising and M&A. So these two things are going to be very important in the next 3 to 5 years. So money is not going to be a constraint. If you can build a good food brand which is tasty, where you've got all the things sorted out, because today technology is available, I think people are there to put in money and participate in this growth.
Sure. Thanks, Hari. Thank you. Thank you very much. Sorry, we run out of time. I've got a time's up sign on the monitor in front. I've got Minnie standing there and saying this. So let's stop this session. I know otherwise we are the first in many sessions during the course of the day. Thank you very much for a patient listening. Thank you to my panelists for making this a very interactive and interesting session. Thanks everybody once again, and wish you all a wonderful day ahead of you. Thank you.